Here is a scenario that plays out every single tax year for thousands of crypto investors. The market moves in their favor. They sell at a profit. They celebrate. And then, months later, a tax bill arrives that is significantly larger than they ever anticipated. Not because they did anything illegal. Because they never understood which of their actions were taxable events, never tracked their cost basis, and never used the legal strategies available to them before the tax year closed. Today I am going to change that. This is everything you need to know about crypto tax, what triggers it, what does not, and how to legally and legitimately reduce what you owe. This is not tax advice for your personal situation, for that you need a qualified professional. But what I can give you is the knowledge framework that most investors never have until it is too late. The first thing most investors get wrong about crypto tax is not the rate. It is not knowing which of their actions are taxable in the first place. Let me be clear on the most important ones. Selling crypto for fiat currency, pounds, dollars, euros, is a taxable event almost everywhere in the world. That is obvious. Less obvious, swapping one cryptocurrency for another is also a taxable event in most jurisdictions. When you trade Bitcoin for Ethereum, the tax authority treats it as if you sold the Bitcoin for its current fiat value and then bought Ethereum, generating a capital gain or loss on the Bitcoin at the moment of the swap. Spending crypto to purchase goods or services is a taxable event. Receiving crypto as income, from staking rewards, yield farming, referral bonuses, or employment, is typically taxed as income, not capital gains, in the year it is received. What is generally not a taxable event? Buying crypto with fiat and simply holding it. Transferring crypto between your own wallets, for example, moving from your exchange to your hardware wallet from Video 6, is not a disposal and does not trigger tax. Knowing this list is the difference between a manageable tax position and a surprise bill. Section 2. The cost basis problem. Your cost basis is the original price you paid for a crypto asset, including any fees. When you sell, your taxable gain is the sale price minus the cost basis. Simple in theory. Complicated in practice, because most investors have made dozens or hundreds of purchases across multiple exchanges at different prices over different time periods, and most of them have never recorded any of it systematically. The problem compounds when you use DCA. Which you should, as we covered in Video 5, because every monthly purchase creates a new lot with a different cost basis. When you eventually sell part of your position, which lot are you selling? The answer matters significantly to your tax bill. In most jurisdictions you can choose between different cost basis methods, first in first out, last in first out, or specific identification, and the method you choose legally determines the size of your taxable gain. Most investors use the default method their exchange applies without ever knowing it exists or that alternatives are available. Understanding this single concept can reduce your tax bill meaningfully without changing a single investment decision. Section 3. 3 legal strategies. Strategy 1, tax loss harvesting. If you hold positions that are currently at a loss, selling them before the tax year closes allows you to realize that loss, which can then be used to offset gains made elsewhere in the same year. If your gains are £10,000 but you realize £5,000 in losses from underperforming positions, your taxable gain becomes £5,000. You can immediately repurchase the same assets if you want to maintain your long-term position, subject to the wash-sale rules of your specific jurisdiction. Check the rules for your country carefully. The principle of harvesting losses to offset gains is broadly available and entirely legitimate. Strategy 2, tax-advantaged wrappers. In the UK, a Stocks and Shares ISA does not currently include crypto assets directly, but as regulated crypto products expand, this landscape is evolving rapidly in 2026. In the US, self-directed IRAs can hold certain crypto assets, sheltering gains from capital gains tax entirely. Check what wrappers are available in your jurisdiction for the assets you hold. Even holding a small allocation of your investment inside a tax-advantaged account legally shelters a portion of your growth from capital gains indefinitely. Strategy 3, Timing disposals around the tax year. Capital gains tax applies in the year you realize the gain, not the year the gain accumulated. If you are planning to sell a position, and you are close to the end of the tax year, waiting until the new tax year begins means the liability does not fall due for another 12 to 14 months, giving you more time to plan, and potentially allowing you to use a fresh annual capital gains allowance. In the UK in 2026, every individual has a capital gains tax annual allowance. Gains below this threshold are tax-free. Timing sales to stay within this allowance, or to spread disposals across 2 tax years, is one of the simplest and most underused strategies available. The most expensive thing in crypto tax is not the rate. It is the reconstruction. When investors come to file their tax return and realize they have never tracked anything properly, they face 2 equally bad options: spend significant money hiring a professional to reconstruct years of transaction history from multiple exchanges, assuming those records are even still available, or file inaccurately and face the consequences later. Neither option is acceptable when the alternative is so simple. Record every transaction as it happens. Date, asset, amount, price, fee. 30 seconds per transaction. Done. The record that feels tedious to create in real time is worth many times its weight when tax season arrives. And it is the record that makes every strategy in this video possible, because without accurate cost basis data, you cannot harvest losses, you cannot time disposals, and you cannot calculate whether you are within your annual allowance. The record is the foundation of everything. Section 5. You do not need to build this manually. In 2026 there is a mature ecosystem of crypto tax software that connects directly to your exchange accounts via read-only API, meaning it can read your transaction history but cannot move any funds, and automatically calculates your gains, losses, cost basis, and tax liability across every asset and every exchange. These tools support multiple cost basis methods, generate HMRC and IRS-compatible reports, and update in real time as you make new transactions. They are not free, but they are a fraction of the cost of hiring a professional to reconstruct years of missing records. The setup takes 1 afternoon. The ongoing maintenance is connecting new exchanges when you use them and reviewing the report once before tax season. That is it. If you have been investing in crypto for more than 1 tax year without using one of these tools, connecting it today and generating a historical report is one of the most important financial admin tasks you can complete this week. Section 6. The tools handle the data. The strategies reduce the liability. And then, once a year, a brief conversation with a qualified tax professional handles the complexity that tools and general education cannot. This does not need to be an expensive, hours-long engagement. A 1-hour consultation with a crypto specialist accountant, armed with your organized tax software report and a clear picture of your cost basis and planned disposals, is enough to confirm you are using the right cost basis method for your situation, identify any jurisdiction-specific strategies you may have missed, and ensure your self-assessment or tax return is filed accurately. The investors who pay the most in crypto tax are not always those with the most gains. They are the ones who arrived at the professional conversation unprepared, paying for reconstruction, paying for errors, paying for the absence of a system. You now have the system. Use the professional to refine it, not to build it from scratch. Section 7. The elite level. Here is the distinction between an investor who manages their tax bill and one who designs their tax position. Managing tax means dealing with it after the financial year closes, reacting to the liability you created without thinking about it. Designing your tax position means building tax considerations into every significant financial decision before you make it. Before you sell a large position, what is the tax year timing? Is this the right side of the boundary? Can you use your annual allowance? Are there unrealized losses elsewhere you could harvest in the same move? Before you swap one crypto asset for another, are you triggering a taxable disposal? Is there a wrapper available that could shelter this? These are not complicated questions. They take minutes to consider. But investors who ask them before every significant transaction, not after, routinely pay less tax on identical portfolios than investors who never think about it until the bill arrives. Tax is not a punishment for success. It is a variable in the equation. And variables can be managed. 7 sections. You now know which of your actions trigger tax, how cost basis determines your liability, 3 legal strategies to reduce what you owe, the record-keeping system that makes all of it possible, the tools that automate the heavy lifting, and the professional conversation that ties it together. The investors who build wealth over the long term are not just the ones with the best entries and the best security. They are the ones who protect their gains at every layer. Market performance, physical security, and tax efficiency. Subscribe to Wealthverse. Next week I am covering something that nobody in this space talks about honestly: what to do when the market crashes and your portfolio is down 40%, the psychological and practical playbook for surviving a drawdown without destroying your long-term position. Because markets will do this. And how you respond in those moments determines everything. I will see you there.